It's kind of two markets, like you said. I mean, a lot of stocks are down 10 or 15% already, those tech stocks that are really stretched. But you mentioned, the 60% rally in the S&P. Now, yes, we've pulled back a good amount the last 2 days. S&P is up 5 months in a row. You go back in history, that's happened 26 times since 1950. 1 year later, the S&P is higher 25 times. So some really good performance. Now, I know every time is different, and I know different things are happening, but just look at today. Like we just talked about, yields are going higher. Materials are pretty much flat. Industrials are higher. You look at Chinese A shares, they're higher as we speak. So I know what's going down. We all know it's the tech and some of the healthcare names. But the market, what it's doing, it's kind of moving from one side to the other. It's not just selling everything. And we think that's a positive sign. So we would, at LPL Research, be a buyer of this dip. Could the S&P go down as much as 10% the next couple months? Maybe, but we don't think much more than that because, again, the economy, in our view, is really improving here.
And yet, Ryan, when you head into Septembers and Octobers of election years, they're typically marked by not very good returns and a fair amount of volatility. So if you were to buy into this market, you ought to buckle your seatbelt, right?
No, you're exactly right. I mean, as everyone said for a couple of days now, September is the worst month of the year. We get it. But during an election year, October is the one you got to worry about. That's the worst month of the year during an election year, probably just pre-jitters. I mean, honestly, that's probably what it is looking back in history. But at LPL Research, we'd still stick with who got us here. I know tech is super overvalued, but there are a lot of those names are coming back. We still like the growth names, tech, healthcare, the communication names. Those are still the areas we like. We also like emerging markets. Again, I mentioned Chinese A shares are higher right now. Emerging markets are an area that's seeing more growth than the U.S. So stick with growth, stick with emerging markets, and use this pullback as an opportunity for a continuation of the bull market is how we see it.
Ron, you have been preaching caution for some weeks now. You're particularly cautious about the so-called work-at-home stocks right now, and also about the role of Robinhood in bringing maybe uninitiated investors into the marketplace. Why don't you bear down on your hypothesis right now as you look at this market selling off?
And if I may, Tyler, just pick up on your biblical point there. The one thing that the New Testament doesn't tell us is exactly how long Lazarus lasted after Jesus raised him from the dead. So that's an open question. So we don't know whether or not Lazarus has much more time on earth. Having said that, when the two pieces I'll talk about with respect to preaching caution, this is why you take profits. This is why you rebalance your portfolio and engage in disciplined behavior when it comes to investing. Traders don't save the market necessarily. Now, with respect to Robinhood, these are the folks who have set the marginal price for a lot of these high-flying stocks. And yesterday there was a report suggesting that the SEC was looking into Robinhood's business model, the so-called payment for order flow, selling those trades to high-frequency traders so that they can keep from charging retail investors. If that business model changes and these new traders start getting charged for their trades, that could upset what has been a bull market in a lot of not just the big name stocks, but some of the dogs and cats that have been running on Wall Street. Now, with respect to what's going on today, I also am wondering whether or not a more rapid rebound in the economy, not my base case, but if that were to take place, whether that would, in fact, hurt further the stocks that are selling off in the NASDAQ. They are, as Josh Brown likes to call them, work-from-anywhere stocks, or anything that's done quite well and thrived during this period of sheltering in place might continue to correct, and money would flow into other areas, as Ryan suggested. And I would look also at developed markets overseas, and maybe even high dividend-bearing stocks that have very strong balance sheets. Those would be some safe haven plays. They may fall into the cyclical camp. They may fall into the financial camp. But I do worry that this market is still vulnerable. I don't think we're out of the woods here yet, particularly given the concentration of gains that we've seen, and any change in outlook could affect those stocks rather disproportionately.